Welcome back, everyone, to the Risk Intel podcast, powered by SRA, where we share risk intelligence from experts across the banking industry. I'm your host, Ed Vincent, Executive Vice President at SRA. Hello, welcome to the Risk Intel podcast. I'm Ed Vincent, and joining me today is certified enterprise risk professional Scott Uselton, who is in his 12th year at First National Bank of Middle Tennessee and his 3rd year as the bank's Chief Risk Officer. Scott, thanks very much for joining us.
Thanks for inviting me. I'm glad to be here.
Scott, you'll do a better job than me in sharing your credentials. So let's kick off there and start with a little bit about your history. Can you take us briefly through the journey that led you to arrive in the risk department at First National Bank of Middle Tennessee?
Well, I came to the bank about 12 years ago to begin a credit administration department. I served in that role for a number of years, and with everyone's help, the bank established a solid credit culture. I would say me landing in the Chief Risk Officer role was the vision of our president, who's always managed the bank based on where we want to go as opposed to where we are. And he assigned me the task of creating the enterprise risk management for the bank.
Yeah, I want to keep going down this, but I want to park that concept of the vision of where we want to go versus where we are, because I think that's going to come back up, and I think that's a really key theme. I know that's something we've talked a little bit about in the past. But let's kind of continue down through that journey a little bit. I'm interested in when you arrived and joined in that credit administration department, and went down that journey that ended up in the risk area. Were there any particular skills that you developed or specific experiences that you can point to that you think really qualified you or enabled you to ascend into the CRO seat?
Well, when I first came to the bank, it was still experiencing some residual effects from the Great Recession. As we know, credit risk was one of the primary sources of risk for all banks, and having experienced credit weaknesses and how its repercussions are felt throughout the bank, it really made me aware of how banking is a function of many different systems operating together. And when one system suffers, typically other systems also falter. So that led me to, kind of an understanding from a risk perspective, the importance of all of our systems working together, working correctly, and the importance of communication between those various systems.
Right. So there's the technical piece, but I think I'd imagine also there's the concept that the risk function is really the glue between all these different parts of the bank coming together and looking at risk across the enterprise as well.
It is. I had actually an auditor one time asked me, he said, how would you define risk management to a layperson? And I said, well, if you imagine all of the risk areas in the bank as silos, the risk officer would be the one laying the planks across the silos to connect them all together.
That's a fantastic description and analogy. That I might put that one aside and reuse that one if I may. I will attribute it appropriately, but that's a great description. All right, so let's you ascended into that CRO seat. You've had some really interesting experience and skills that developed, right? Plank laying and otherwise during your ascension to that role. Can you share an example or two of how then you've applied those skills and experiences in the role as Chief Risk Officer?
Well, roughly 10 months after SVB Bank and Signature Bank failures, the banking industry is still experiencing elevated liquidity risk.
Yeah.
When we think about liquidity risk and liquidity in general, we must also encompass interest rate risk into the thought process. In times of a normal shaped yield curve, it can be luring to stretch maturities to capture more yield, but we must always keep in mind the changes of interest rate environments and duration. In stress times, those can definitely impact the asset values of the bank, which we're experiencing, creating the liquidity issues that we have today. So interest rate and liquidity risk are examples of what I refer to as systems, and they have to work together.
And it feels like your background there, working in the credit area, is extremely valuable because you've got a real strong foundation in those areas.
Correct. I think coming up through the credit channel and into risk is unusual, because most risk officers that I've that I communicate with on a regular basis, they come up through audit or accounting.
Right.
So I do believe that coming up through the credit side of the bank has given me a different perspective of risk. Not that, I really enjoy communicating with the others that have the background, because you really need both to be effective. And when your risk department is completely built out, I think you'll have credit-wise people, credit people, as well as the audit and accounting side.
Yeah.
Another example of how I view talent and succession as systems that must work together as well. We, like most community banks, we have seasoned, well-experienced staff. In order for those systems to be working together, all banks must leverage the knowledge and experience of the senior talent to groom the younger staff. Talent and talent management through proper succession identification and training is key to long-term success. If either of those systems falter, that could have serious implication to a bank's future. So, coming up from credit, we we have our seasoned, well-experienced lenders, but we're also concerned about bringing up that next generation. And that's not just on the lending side, which, again, coming up through credit, that's my history. So many times I'll refer back to it, but that's throughout the bank. We have department heads that have been with the bank for 20, 30 years. The knowledge that they have, it's not written down. We've got to be able to pass that stuff along so that we can have that longevity put into the bank and the organization to continue it moving forward.
Sorry, you're hitting on a theme there also that things are dynamic, right? The bank is a dynamic organism and entity, and right, you can't accept things being static, whether that is systems, data, technology, people, processes, right? And succession, right, fits right in that grooming and developing and helping people progress through their careers is another element of a dynamic system inside the bank.
Absolutely. And those dynamics are part of the risks that we have to manage.
Yeah. So let's shift then now to the bank itself, right? You've taken us a bit through a bit of your journey. You've also seen some really interesting growth and progression there at the bank, right? From when you arrived at a bank that was, $500 million to one now that is, north of $850 million. So can you tell us, go back to that $500 million bank for a minute, when you were a senior member of that credit team? What was the culture of risk? What was the risk perspective of the bank at that point in time?
The risk culture of the bank at that time was like many banks, especially small banks, and $500 million is a small bank, $850 million is a small bank relatively. But we managed, again, referring back to silos, we had silos. We did not have those planks that were laid across those silos. Therefore, I would say that the credit culture was splintered. We always managed risk, but we never managed risk collectively. And I think that, again, is the concept that enterprise risk brings to an organization, is to manage that risk collectively. Many times there's areas or departments that can take on risk that will either exacerbate risk in one area or maybe mitigate risk in another area. So risk has got to be viewed holistic at the enterprise level for it to really provide the strategic opportunities that enterprise risk is supposed to provide. Again, from how we monitored our risk, it was spreadsheet based. Again, very splintered. The risk scales would be different. One may be a 1 to 5 scale. One may be a low, moderate, high scale. So consolidating those into a uniform, concise risk management or risk management tool was almost impossible. So again, that's the credit culture, or excuse me, the risk culture that we had, that I don't think is unusual. I think it's part of the growing process. And as those processes, as the bank matures beyond those processes, they do begin to get into more of a formal risk program.
Well, was there a view of what was the bank's view around risk appetite, how mature or thoughtful or purposeful was that? Or was there a real intentional approach to understanding the risk appetite?
When I first came, no, there wasn't, and really the risk appetite was more of a subjective statement than a qualifiable or quantifiable statement.
Yeah.
And that's not a bad way to start. You know, you've got to walk before you can run, and I think those subjective statements get you in the mindset to move it forward, to start putting some quantifiable data into your risk appetite statement. So again, I don't think that we were unusual at all. I think it's a process that all banks go through. I do think that the complexities that the banking industry is facing today is going to cause more of the smaller banks, the $500 million, $850 million banks, to move towards a formal enterprise risk system much quicker than they did probably just pre-COVID.
Well, so let's pick up on that, right? Because when you explained there the risk culture and the systems and the processes that were around a dozen years ago. Clearly, there was a mindset though that you were going to progress from there. You were going to grow the bank, and as a result of that, you were going to need to grow the risk function. So, can you talk a little bit about that vision of growth and when you were at 500 million, did you have a pretty good sense as to where you were going and what you needed to do or what you wanted to do from a risk perspective?
Well, we've always, I think management of the bank and the directors, we've always been growth focused. We've always wanted steady, profitable, and well-managed growth. Yeah. I can't say that we necessarily had $1 billion target, but we're always aware of the implications associated with being $1 billion. And having a risk focus will definitely help us with those implications. As I said, like most banks, we're growth focused, and managed growth requires, identifying obstacles or risks before you run up on them. I think this is where enterprise risk provides its return on investment. If the obstacles or risks can be identified through a well-functioning risk system, they can move easily be navigated around and greatly reduce the strategic risk which often accompanies growth.
So was there a risk function specifically at that point in time? It sounds like it was a vision, but it wasn't really there. So, when did it come into being, right? When did this chief risk officer role originate? Now,
the CRO role, it originated 3 years ago at the bank with me becoming the risk officer. Again, the president and his vision to proactively manage the bank, that was the catalyst behind the creation of the risk management. I also think there's, some subtle pushes from the regulators for banks of all sizes to begin formalizing risk management. As we know, most regulations start at the big banks and they inevitably trickle down to the smaller banks. I do know that a lot of smaller banks in Tennessee have begun a formal risk management process.
So the bank was how large when you stepped into that CRO seat, and what did you encounter at that point in time?
The bank was about 580 million in assets. Again, what I encountered, as we talked about before, the risk culture was splintered. Everyone viewed risk in the context of their departments and really didn't consider how risks in one area can affect the risks in another area or offset risks in another area. We had a variety of assessments that we used. Again, varying scales, very difficult to bring into a common measurement that could be used and effective action being taken at the enterprise level. So. That's kind of where we were. Fortunately, and again, with SRA Watchtower's assistance, we're moving well beyond those days.
So let's talk a little bit about that, the changes, right, that you enacted. So, right, we understand kind of the vision of the bank was to grow, to progress from a risk management perspective. take us a bit through a bit of that journey. What were the first changes that you enacted there within the risk function?
Well, for me in our bank, it seems change is perpetual and necessary because of the environment we operate in. The risk management always maturing, but never really matures because of the changes in those operating environments. We try to have our finger on the dial of what the change may be in 6 months to a year, but life happens, right?
Right.
We're still changing, but I'd say our initial changes, which we're still working on, is our view of risk. We're always taught that when we hear that something's risky, well, we've got to avoid it. However, banking is and has always been in the risk-taking business.
Right.
I wanted to get across to my coworkers that risk is not inherently negative if it's properly managed. If banks don't take on risk and manage that risk to acceptable levels, its return on shareholder equity will likely not be as strong as it would be otherwise.
Yeah, a couple of great themes in there, right? That risk is not necessarily meant to be avoided, and it's not inherently negative, right? Yeah. The fact that it is necessary in order to grow and have a successfully functioning bank, but it is you've got to be aware of it. You've got to look at it holistically. You've got to manage it strategically.
Right. I've said risk is like a power tool. You can use it to create wonderful things, or you can cut a finger off.
Another one I'm jotting down on my scratch pad here. So do you have a vision there of where you want to take the risk function from here, right? You're approaching that $1 billion threshold, right? Which has some implications, but I know that you, right, as we've talked about in the past, that, risk doesn't end at that point. Risk management doesn't end at that point. So, right, talk to us a bit about, where you see the risk function going.
Well, I believe our bank shares some similar characteristics with those that are $1 billion to $2.5 billion range. I do think that some of the risks of our market, our operating environment, causes us to, our risk profile to be a little bit more elevated than where we actually are in asset size. And due to this, I'd like to see the bank manage its risk similar to that $1 billion to $2.5 billion bank. SRA Watchtower's maturity framework is a vital key towards our bank reaching that vision. By managing the bank's risk in this manner, I do believe it will provide much more solid footings and allow the bank to be prepared to capture those strategic opportunities that we may have otherwise missed.
Well, so let's talk a bit about that and bring us here to the present day, right? You've just gone through this process of looking at going through the risk maturity framework diagnostic, which, as you said, helped really crystallize your thinking in some of these areas. Can you share a couple of observations and learnings from having gone through that assessment?
Well, first, I'd like to start with the process of completing the assessment. A member of SRA Watchtower's team was educational, patient, and coached me through the process, making it enjoyable. And believe me, patience is the key word with that one. My observations were many. The framework's granular and not only allowed me to see where I am in the maturity process, but also provided me with process improvements to get me where I want to be. It's been said that I've got an knack of overcomplicating things. For me, one of the best attributes of the framework is it showed me where I need to establish my limits. For a bank that's not quite $1 billion, I believe risk management can be over-engineered, which could impact sustained buy-in, jeopardize the risk culture, and reduce risk management's return on investment. I really like the guardrails it put up for me to prevent me from overcomplicating the risk and risk management process.
I love that point, that it is, right, you live it every single day, so it might not seem complicated to you, but it needs to be digestible by the rest of the organization. You've got to be really pointed and
that's absolutely correct. The buy-in is the key. Every successful risk management area, they have got to have buy-in throughout the organization.
Any particular surprises that you uncovered as you went through the diagnostic process?
Actually, I was surprised that I was a little bit farther along in the maturity process than I thought I was. But it still shows me I have a lot of work to do, not only to continue my maturity process, but also to tell me where things that I can't let lack. I can't back up, because you can easily back up on this process if you let some things fall off the wall.
Yeah. We'll you now have also a way of being able to communicate where you are on this process, right, with others, beyond the risk department. So will you use this framework then, whether it's with a risk committee or someone outside of the day-to-day risk function?
Yeah, absolutely. The risk maturity framework will be a frequent topic in our management risk committees meetings. For the risk management process to be hitting on all cylinders, again, it takes all of management to know where we are and where we need to be. Risk management can't be done effectively without all of management being engaged and well informed, and this is going to be the primary tool to help me achieve that. As for board reporting, they have to see that management's engaged in maturing risk management as part of their oversight responsibilities.
Right.
To me, risk management is part of the board's oversight responsibilities, and the risk maturity framework will be essential in assisting them with their oversight responsibilities. And as for the regulators, I expect them to not only ask about my maturity, but to substantiate it. Without something like risk maturity framework, there could be too much subjectivity in the substantiation. And with this, I'm confident our discussion is going to be short.
Yeah, the fact that you now have there's a common language, and that you can quantify this, right, with all those different constituencies.
I have all the information to substantiate it, and I'm probably unusual as I enjoy the examination process, and I'm looking forward to this discussion when they come.
Yeah, right. It's great that we've had some conversations with regulators as well, and they love the fact that it guides the conversation to where you can have a purposeful, helpful, productive, constructive discussion instead of this wide-ranging conversation that is not necessarily deep and substantive. You're focused on the areas where, right, you can collaborate, you can really drill down, and you can focus on a specific issue.
And I do plan going forward that the risk area to be one of their primary stops in the bank, because again, it captures so much data for the organization as a whole.
So you've got a baseline, you understand where you are. How do you then take this forward and look forward at 2024 and beyond, and take this risk plan and align that with the bank's strategic plan?
Well, for 2024, I expect the banking environment to prevent some of the same challenges it did in 2023, but I also expect new challenges. I believe the intensity for liquidity will continue, exacerbate the need for interest rate risk management. There's a likelihood we'll start experiencing headwinds in credit quality, and just adding to the risk and its complexity. Operational risks will continue to rise due to the never-ending cyber threats and fraud. Our goal would be to manage those threats in a timely manner, measure these threats, and determine what risk strategies we want to use. SRA Watchtower will be our primary method of bringing all this information together in a format that allows for easier management and quicker action to be taken, so that we can continue to achieve our strategic plan with minimal interference from those risk events that we expect in 2024.
Well, I appreciate you acknowledging the fact that we can be helpful along that journey as well, and give you a common language and a way of communication, sharing that information. I think it's exciting from our side to see that the tight coupling between risk and strategy, right? We had a podcast where we talked about risk and strategy being two sides of the same coin, right? And those having those two elements, they're so interrelated, and it sounds like you really have connected those two here within the bank as well.
Well, risk and strategy combined allows us to have a risk-adjusted return. You can go to Vegas and win a lot, but how often is that? What's that risk-adjusted return actually going to be? So, our focus has been steady, manageable growth in revenue as well as earnings, and we want to make sure that we're taking the appropriate amount of risk for that level of earnings that we're generating.
So I think that's a great way to lead into my final question or two here to close. The first is, why is it important for a bank that's not yet $1 billion in assets to invest in a robust risk management function?
Well, I think I may have mentioned earlier, banking, we're in the risk-taking business. Risk is relevant in all banks, regardless of size, and also regardless of size, many banks share the same risks. And that being the case, I have to ask, why does size matter? With margins continually being squeezed, so are banks' margin of error. Proper risk management and risk management tools reduce that margin of error, which allows us to maximize our earnings. And ultimately, risk management and the information gained through its process will drive our earnings in the future. And I say our earnings, I think it's going to drive all banks' earnings.
Yeah. It's right. You mentioned there that many banks have the same risks, right? And that's one of the reasons of having these types of conversations, is to help folks realize that they're not navigating this thing, this journey alone. There are other folks that have gone down this pathway and are willing to share thoughts and perspectives and experiences. So I appreciate you sharing.
I'm in a risk a forum of risk officers, and the banks in there range from 50 billion to 250 million. And it's interesting, we can all sit around the same table and share the same issues, same risks.
Yeah. So I'll close then with to that point, right? Of sharing perspectives. In 2020 hindsight, what advice would you share with risk and compliance professionals operating in a bank such as yours? Right, growing rapidly but purposefully, right? Approaching that $1 billion mark. You look back on what's been I think it sounds like a really interesting and insightful journey. What advice do you have to say? What do you take away from the last few years in this chair?
I'd say start early. Take a critical eye of your bank and be honest about the risks in your bank and the markets it operates in. Consider those risks not only in your strategic plan, but to your strategic plan. Then figure out how you can monitor, measure, manage, and report those risks in an accurate and timely manner so that appropriate actions can be taken when needed. I think if banks really take a hard look at themselves, it would be hard for any bank not to justify enterprise risk management.
Scott, I've got pages of notes here I've been jotting down as we've been going through. A lot of fantastic themes, from laying the planks between the silos to really thinking about risk in a dynamic manner, looking at it and viewing it at an enterprise level and holistically, and that last point there of starting early is such an impactful one, right? Those are great themes. I appreciate you introducing all that, taking us on the journey there at First National Bank of Middle Tennessee. It's been great to spend a bit of time together, and again, thank you for the insights and perspective today. We appreciate it.
Thanks, Ed.